And for any property acquired after a certain date in 2017, essentially 2018, you could take the accelerated depreciation deductions that you come up with.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It Passive Investor Edition podcast. My name is Randy Smith, and I will be your host today. And I am super excited to have Yonah Weiss with us today. Yonah is the Cost Seg expert in the space, and he's also been in and around real estate and passive investing for years and years. So I think he brings a unique perspective that I'm sure you guys will all enjoy. So Yonah, welcome to the show.
Thanks so much, Randy. Great to be here.
Awesome. Well, why don't we just jump right in? Yonah, why don't you tell us a little bit about yourself, kind of walk us through your journey, and tell us how you found passive investing and then the cost seg space.
Absolutely. My background was in teaching for many years. About 15 years I was a teacher. It really has always been my passion. I started a nonprofit, so helping people was kind of my sub-passion. Having a big family, 6 kids, so I'm like always teaching, whether it's in the classroom or at home or both. And about 7-8 years ago, I had some changes in my life that really required me to do some introspection and wanted to find some additional sources of income. Real estate kept coming up in every conversation that I had with friends of mine, acquaintances. I just put it out there, looking for an opportunity and to do something more than just teaching. Real estate kept coming up, and 2 reasons why that was a big impact on me at the time was, one, I was not interested in going back to have any sort of formal education, and a career change, without that is somewhat limiting, right? But real estate didn't have that barrier to entry, at least from what I was told for a lot of people. And the second thing was that there's really no ceiling. All right, real estate is an industry that you can literally, there's no ceiling to how much you can actually make if you want to. Now, money was never a driving force, just have enough to get by and be able to help out others. But it obviously was something that was intriguing. And I started out with just really learning, as a lot of people do. I was blessed and fortunate to have a good friend who basically coached me, and I was an apprentice with him. And obviously he was a mortgage broker. He himself owned rental properties, some multifamily and single family properties, and managed them himself remotely. And it was a really eye-opening experience for entering into the commercial real estate space. I ended up doing some brokering as well, real estate, got my license, and ended up doing some fix and flips, getting my feet wet. But it was about 5-6 years ago where I was introduced to this concept of cost segregation and introduced to this company, Madison SPECS, which I currently work for. And it was a great match. They were interested in someone doing business development. I didn't really have any tax or engineering background whatsoever, but that's not what they were looking for. They were just looking for someone to what ended up really being teaching this concept, teaching cost segregation. That was really my angle. And I, thank God, become extremely successful in that space, being recognized as the #1 cost segregation expert in the country. And that really has opened up so many doors to me, working with thousands of clients across the country in every asset class, in every market, and really opened my eyes up to passive investing as well, which, all being together, just being involved and around people on a daily basis that are owning and investing in real estate, and many of them doing syndications. I learned about passive investing. So, finding the right sponsors that I was comfortable with, I ended up investing in, at this point, about eight deals, 8 different in several asset classes, and gotten my, learned a tremendous amount, obviously looking at hundreds along the way until, finding those right ones. So it's been a great journey.
That is, God, there's so much information there, and what a journey it's been. I love the fact though that you're a teacher in heart, which I think, salespeople can kind of get a bad name for themselves, but I think the best salespeople in the world are not salespeople at all. They're just educators, and they're sharing value, and they're teaching other people something that will benefit them. And if it makes sense for them, great. If it doesn't, it does not. So I love how you bring that teaching heart to the space. So now you mentioned that you've been involved in a number of different facets within real estate. You mentioned a lot of our audience, they did the fix and flip thing as well, like myself. I didn't do flips. I did long-term flips, i.e. the BRRRR, right?
BRRRR, yeah.
And then you were actually a broker and an underwriter on loans as well that I saw. So you've been around this space for quite some time. And it's interesting how you mentioned that there's not like a formal education process you have to go down. So I'm curious that learning and educating through experience, how did that evolve? I know you mentioned you found somebody and there was an apprentice, but talk to me about that process a little bit more as well, if you can.
It's a really ongoing process. And for anyone that's interested in learning, there's so much information out there nowadays with podcasts and, YouTube and articles, books, so much. And I consumed a lot of that, and continue to do so. But from the way that I learn is much more experientially. And so being able to just sit with people and watch them or spend time with them and do things, if you can go walk a property, that's going to teach you so much more about the property than, looking at the operating, the memorandum or whatever it is that you're the operating memorandum. So to me, it's always been about who can I surround myself with and who can I learn from. I didn't become the cost segregation expert overnight, but I relied heavily on the company that I work for, which was the biggest cost company in the country, who had those experts that I could basically rely on. And without them doing the actual work, I wouldn't be the expert that I am, because you don't have anything to offer. And so for anyone in any space that there is, if you can find a mentor, if you can find someone that can accelerate your growth, you'll learn so much more than trying to figure it out on your own. And as a teacher, I think I maybe have a little bit of an advantage, because as a teacher, you're constantly learning, because you want to learn not just in order to understand yourself, but in order to teach it. And to learn at that level, you have to integrate it in a way that is much more palatable to others. And so for me, teaching this, over and over again, if I get a question I don't know the answer to, I'll go and ask, one of the CPAs or one of the, guys on my team that's been doing this for a decade, and I'll have the answer and I'll know it, and I'll be able to tweak that and get better over time. And that really has been an ongoing process, just kind of focusing on that one niche. But again, it comes back to relying on others and not trying to figure it out on your own.
Yeah, no, I love that. And I think, there's a true sense of humility in what you're sharing there, because the guy who comes to the table that claims to know everything is never going to learn anything new. And it seems like you've had a tendency to, associate with people that know a lot more than you do in certain spaces. But then it sounds like there's not a lot of hesitancy towards action and moving forward. So I am actually, I'm kind of a ready, fire, aim guy. And it sounds like you might be a guy that builds the parachute on the way out, jumping out of the plane as well. Is that true, or?
Maybe to a certain extent.
Okay.
I think there's a lot of caution, that comes along with it, but you can never be afraid to act. And I think if you have a good understanding of something, you can take the jump and you'll learn a lot more along the way. Like you're saying, I don't know, the analogy of jumping out of a plane without a parachute is not something I've ever used before, but if that describes the situation, then yeah, certainly.
Yeah, certainly. And you have a little more confidence if you're with an expert parachuter next to you as you're jumping out, right? So
right.
Interesting. Okay. So let's talk. It sounds like you ended up moving into the cost seg space and then came into passive investing, but I want to do that backwards if we can. Can we talk a little bit about your passive investing journey? What was that first deal like? How did you find the deal, the operator, vetting, all of those types of things? What did that look like?
So it's been a networking experience for me, and specifically through using social media and LinkedIn for the last 5-6 years. It's just been an incredible experience building that community. And I've met so many sponsors, so many, people who have been my clients, but also, going to networking events, but also just people that, they send me their deals, you get on their list, whatever it is. And so for me, it's always been more about the operators than it's been about the deal itself. You can look at 100 deals and they may all look similar in terms of the returns or, what people are projecting. But in the end of the day, you want to make sure that the person is trustworthy, is reliable. And even if there is, a fumble in the deal itself, you rely on their integrity and transparency to make sure that, everyone winds up on the right side of things. And unfortunately, there are plenty of people out there. There's no shortage of people who are, unfortunately, doing things the wrong way and have had fraudulent behavior and things like that. I've come across a lot, unfortunately, in the years that I've been in the space. So you have to be very careful. So the deals that I've invested in have been specifically about the sponsors and connecting with them and building relationships with them over the years before, jumping into just putting my money with anyone.
Awesome. I love that because and I think you're in a unique situation where you get to do business with folks and see how they show up over time. You get to deliver the cost seg report and analysis that maybe it comes back at a percentage that they're not expecting, or maybe it's not what they're hoping for, and you get to see how they respond, which I think it's everybody looks wonderful when things are going well, but when things don't go so well, I think the true person shows up. So
you're absolutely right. I mean, and that when you said that, literally, a few people jumped out in my mind that were exactly that, deterrent. When you have someone who's very demanding, and it's absolutely correct. It's the personality, and it's about who that person is when things don't go right is what you want. And unfortunately, if you're just looking at an investment deck or you're looking at a webinar, you don't know. You only see the roses. So it's important to see the other side as well.
Yeah, really good point. Really good point. Thank you. So, all right. So now you mentioned that you are in multiple asset classes and multiple operators, and I'm curious, what are you excited about today in the passive space? Are there asset classes, operators, trends, things that you're seeing that are exciting you right now?
Sure. So I've invested in multifamily, self-storage, mobile home parks, RV parks up until this point, a couple of businesses as well. But for what right now, we're looking at, beginning of 2023, what I'm seeing is, obviously the debt situation is difficult. Financing is much more difficult than it's been over the past decade or so. And that's challenging for a lot of people, especially multifamily. Cap rates being compressed extensively in markets. But I am seeing operators who are successful in the multifamily space in tertiary markets. So people that may not be primary markets or secondary markets, but that these people themselves have been successful in those tertiary markets where you still there's still growth happening, and they are local and understand it in a way that, that someone from out of town would never invest in that space because of the challenges that come with that. And so that is an advantage of just growing that network, meeting more people, and finding people who do fit that mold. However, I specifically want to focus more this year on more affordable housing. So that really includes the mobile home park or manufactured housing communities, as is more politically correctly accepted nowadays. Because they're a little bit different, than a standard trailer park or mobile home park that people have some stigma with. These manufactured housing communities are really extremely affordable housing, really well built, not too different, and even better quality than a lot of stick homes. And I've, been blessed to have a lot of operators in this space, and the one in particular that I'm very close with, and have become very close with the principles of this, and hopefully going to be partnering with them going forward on a lot of deals.
Awesome. Yeah, no, I think the numbers definitely suggest that there will continue to be a need in the affordable housing space. housing as a whole, but I do like that. It sounds like you have a heart towards helping as well, which I think is definitely respectable. So, well, very good. So yeah, so passive investing, and let's jump into, if we can, cost segregation. So for the newer passive investor, because our audience is, folks usually in their 0 to 5 passive investments. Can we talk, explain it to me like a 6-year-old, what a cost segregation is, if you could?
Absolutely. It's cost segregation is a tax deduction, essentially. It's an advanced form of depreciation. And depreciation is an income tax deduction that anyone gets for owning a property, besides for your primary residence. So if it's a business or investment property, you're literally able to take a write-off of the value of that property over a long period of time. So you're able to take a deduction approximately about 2 to 3% of the purchase price every single year for either a 39-year period if it's a commercial property, or a 27.5-year period if it's a residential or multifamily property. So that's what depreciation is. It's a deduction based on the principle that that things go down in value as time goes on. Now, it's not intrinsic to the property and actually going down in value. In fact,
Right.
The property is really going up in value. And it's not intrinsic to the property because it's based on you as the owner and not on the actual building, meaning that schedule of 27 or 39 years starts the day that you buy the property. And so it doesn't matter that someone else has already taken that depreciation deduction over 30 years and then sold it. The new owner gets to start that again. So that's depreciation. Now, cost segregation is just like the name, even though it's a weird name, how it sounds. We're segregating that cost into different categories or different components. So the IRS says certain components of the property actually depreciate faster, and you can take the deductions of those components at a faster rate over a 5-year or 7 or 15-year rate, as opposed to that longer 27 or 39-year rate. So a cost segregation study is an engineering report of a property that breaks down every individual component, like appliances, furniture, carpeting, fixtures, cabinets, like everything has a different schedule, taking the value of those items and then taking a deduction, a much bigger deduction in those earlier years. So in a nutshell, just if I were to recap, that once you know what I've just explained, it's a cash flow tool that allows you to take more tax deductions in the earlier years of ownership.
Love it, love it, love it. So the added expense benefits the added expense of the depreciation benefits the real estate investor because it offsets the potential income that's coming from those.
Correct. Yeah, exactly.
Okay. So as a passive investor, if you're trying to factor that into the whole equation and understand the full benefit of investing passively, how do you explain that to the newer passive investor then?
So many people get into real estate for one of the reasons is the tax benefits that come along with it, right? And we hear this a lot, tax benefits. The major tax benefit is this depreciation deduction. However, there is a difference between the income you're getting from your passive investments. Real estate, for example, if you have real estate investments and they're passive, are treated differently than your other sources of income. Okay, so it's important to note, especially for someone who is a W-2 worker and they invest in real estate as well, it's important to understand the distinction between how depreciation and how cost segregation works and how it can affect you versus someone who is full-time in real estate and how it affects them. And this is something I think a lot of people don't know or don't understand or aren't explained well. So the main benefit is that the depreciation deduction can be used or is primarily used to offset or to reduce your taxable income from your investments. So from your rental income, any investments that you have are kind of all lumped together, and any depreciation deductions you have are lumped together. When investing in a deal where they're doing cost segregation, you will receive the proportional amount of deductions based on your interest, based on your percentage of ownership. And that will be used to offset your income. So depreciation, real estate is one of the only, if not the only, investment vehicle that you can actually make money on and during the course of ownership, not actually pay any taxes on the income from those investments because of the depreciation expense.
Love it. Yeah. So that it's, and you alluded to this idea of if you're in real estate full time, then there's this opportunity for you to count those losses against your active income or active income within the household potentially. Can you talk about that a little bit? And of course, air quotes, we're not CPAs, talk to your CPA, but in your experience, Yonah, how does that work?
Yeah, it's extremely important. So if anyone is a real estate professional, as the IRS defines, is that either you or your spouse do not have another full-time job, and your full-time job consists of materially participating in the real estate trade or business, which can include managing, operating, acquiring, brokering, constructing, any of the above in your own property. So if one of you of a couple is either a real estate broker, or you own some rentals on your own, and that's your main occupation, and there's a time limit as well. There's 750 hours a year is required. However, once you have that, then just like you said, Randy, you can use these depreciation deductions to offset your active income or your W-2 income as well, which is not someone who is just solely a passive investor, a non-real estate professional. And that's really where the main benefit of cost segregation comes into play, because it's great, sure, to have the rental income or the real estate income you're getting during the course of ownership from your investments not be taxed because of that huge depreciation deduction. Mm-hmm. But it will be even better if you can use those extra deductions to also offset or reduce your other taxable income, which can be extensive. We're on $1 million property, for example, and this can be multiplied. You can sometimes get a $150,000 to $200,000 tax write-off in the first year or in the early years. So that's a huge amount that can be used, which is well above the income from the property itself. So you're left over with these extra losses or these extra deductions that can be carried forward. You can use them in the future, but to be able to use them in the current year is only limited to that real estate professional status.
Love it. Yeah, and that's kind of the unicorn that we're all, in my space, we're all searching for. It's that high-income W-2 earner that has a spouse that can designate as a real estate professional, and it really creates a unique opportunity for some tremendous tax savings that, it can be a reason to completely restructure your career focus and your entire life, quite frankly, if you can get that created perfectly, of course, with your CPA, sign off on it. So
for sure.
So now, go ahead.
I would just say there is one other exception to the rule, which is less commonly talked about, but is probably as powerful, if not more powerful, than the real estate professional status, which is with short-term rentals. And there's a specific rule regarding short-term rentals. I know a lot of people invest in those Airbnbs as well, that even without being a real estate professional, even if you have a W-2, as long as you have a property that's a short-term rental and you're self-managing it, and the average stay is less than 7 days, the IRS has specific rules regarding the passive loss activity, which means the ability to use those depreciation deductions to offset your active income. And so the barrier to entry is much, much less in that regard, because all you need is to what's called materially participate, and there are 7 different rules, but the 2 most common are 500 hours a year spent on your properties collectively, if you have short-term rentals, or 100 hours a year plus more time than anyone else. So if you are the one that is self-managing it, it's likely that you'll have that qualification. And I've seen hundreds of people literally who have gone into the short-term rental investing space specifically so that they can use cost segregation to offset their W-2 income as well.
So it actually will offset, because my understanding is short-term rental income is considered active income as well. So it not only offsets that, but actually can translate over to a spouse's W-2 income.
Correct.
As well?
Yeah,
wow.
Absolutely.
Wow. Okay, so that would suggest a strategy where the passive investor with a high W-2 income spouse, by owning one short-term rental, could potentially check the box. That is powerful. Wow, huge. Fantastic. Yeah. So yes, That right there is the reason why our listeners should be listening today. So fantastic. Not only all this other understanding stuff that you shared. So very cool. Well, let's also, if we can you talk through accelerated depreciation? There's some changes that are going on there that could impact this space slightly, albeit not as big as I think a lot of people think it is.
Sure. So with accelerated depreciation or cost segregation, basically interchangeable in the vernacular, was this law that was enacted. Really, it was changed. It's been around for a long time. Cost segregation has been around for a long time, for many decades. But there's something called bonus depreciation that was introduced in 2017, and for any property acquired after a certain date in 2017, essentially 2018, you could take the accelerated depreciation deductions that you come up with a cost segregation study. So once you've done a cost seg study and have allocated some of those costs to a 5-year or 15-year schedule, you have the option to take 100% of those deductions in the first year. And so that's called 100% bonus depreciation. They wrote into the law that it would start phasing out. So 2022 was the last year for taxes to take this 100% bonus depreciation. Going forward, it's going to start reducing by 20% a year. So this year, 2023, it's currently at 80%. So if you buy a property in 2023, you can still take 80% of those accelerated deductions in the first year. The remaining 20% can still be spread over that 5 and 15-year schedule. So you're still going to have the cost segregation benefit, but it is going to, again, start phasing out more, continue to phase out, each year after this. So it's still extremely beneficial, but not as much as it had been for the past several years.
So even without bonus depreciation, though, cost segregation, accelerated depreciation is extremely powerful in this space. So even if we don't see some change in the legislation with the incoming administration or the potentially different administration coming in, it's still extremely valuable. It doesn't mean that Yonah Weiss has to switch into another type of business. Cost segregation, bonus depreciation will still be in place and available, right?
Sure, absolutely. And thankfully, I have the passive investments to keep me going regardless. But yeah,
Exactly.
You're absolutely right. Cost seg has been around for a long time, has been extremely beneficial for a long time. Certainly, the 100% bonus depreciation gave it a kind of boost, but it will still be around and it's still going to be beneficial for a long time.
So, and I'm wondering, do you have any insight? Are you hearing rumblings, or are there talks about this potentially being readjusted or coming back in new legislation? Any insight you can share with the audience?
There have been a lot of talks in the industry, and I think it's going to have to do more with legislation and with who's in the office come 2024. But there's certainly potential for it to be brought back to its 100% level of bonus depreciation. I know many people and many industries have petitioned or lobbied to and written letters, etc., to their representatives, which I encourage people to do. Right, write a letter to your local representative, tell them this is important. It needs to be reintroduced into the law. So yeah, there's definitely been a lot of rumblings in the industry. Officially, anything coming from legislation, I have not heard anything. So it is still up in the air, but we'll see.
Okay. And then we can't have a discussion about depreciation without talking about recapture. So can we talk about that a little bit as well?
Sure. Yeah, so you're absolutely right. Well, we can. In fact, many people do have the conversation.
You're right. You're right. Yes. Yeah.
With that. But we shouldn't, which is, I think, the point you're getting at, is that there is a point when you sell a property, any property, whether you've done cost segregation or not, is you're going to be faced with a tax called depreciation recapture tax. So it's similar to a capital gain tax, in which everyone is familiar with. If you sell the property for a profit, you are going to be taxed on that gain, on the amount of profit. Similarly, depreciation is considered an unrealized gain because you have benefited from these deductions on the sale. That unrealized gain is going to be recaptured, meaning you're going to be taxed on that amount. It does not mean that you have to pay back depreciation, those deductions. Okay, because that's something people are very confused by and think that's the case. It just means you're going to be subject to a tax based on the amount of depreciation that was taken. So if you do a cost segregation and bonus depreciation, you're going to be taking a lot more depreciation up front that just means that you will be faced with a higher tax on the back end, on the sale. Now, there are ways to actually offset that or defer that tax. So it's not black and white that you have to pay that tax. And so this is something that also a lot of people are confused. If I do cost segregation, I have to pay that back. That's not true.
Mm-hmm.
It just means you're going to be subject to that tax. Having a proper plan in place, one way to defer that is to use what's called a 1031 exchange, which is less common when investing passively, but still can be done with the right structures. The more common way that people do this is just to continue to invest and continue to buy or invest in more properties. And the the losses that you will get from depreciation from one property can actually be used not only to offset your income, but also to offset that gain from that depreciation recapture tax on the sale. And a very common case is actually when you do this bonus depreciation and get a huge lump sum of these depreciation, and you're not a real estate professional. You can't use those deductions in the current year. They'll carry forward as a loss. Now that carry forward loss actually gets released on the sale, and you can use that to reduce or to offset the recapture. So again, it's not like a penalty per se. It's just part of the rules and something you definitely have to be aware of.
Mm-hmm. And so what I'm hearing is it is a complicated process, and our listeners need to have experts like yourself and their CPA involved in those discussions and those calculations in the strategy that a passive investor is really trying to leverage. So certainly we'll give you an opportunity at the end, but connecting with somebody like yourself as a guide and as a teacher, I think is really, really valuable for our listeners. So, well, I'm looking at the time here, and I always wonder, like, are we going to be able to get a full half hour? And then at the end, I'm thinking, gosh, I wish we could do 45 minutes or an hour, but I always try to be respectful of the listener's time. And certainly I think it warrants additional conversations down the road. But you've brought just a ton of value. So thank you so much for being on the podcast. And I do have a few questions I like to ask folks at the end of every episode. So
Sure.
This is a common question you probably heard 100 times, but what is a favorite book or a favorite podcast that you personally have learned or are currently learning from to continue the education process?
Absolutely. So, I'm biased. My favorite podcast is Weiss Advice. It's actually my podcast. A little plug there, but to be honest, that's the only podcast that I really listen to consistently. Is
okay.
Just to listen to the interviews that I've conducted over to make sure it comes out well. But other than that, in the industry, there are a ton of books. Tax-Free Wealth by Tom Wheelwright is an excellent book just to understand taxes. And in fact, it's really opened up a lot of doors to myself and many clients of mine that didn't even know depreciation, didn't even know different ways of how to use the tax code for your benefit, which is really what it's meant to be done. It's not a penal code. Rather, it's just kind of a game book, a rule book, if you will. So I would highly recommend Tax-Free Wealth. Again, Tom Wheelwright, Rich Dad Advisor. And we'll leave that.
Awesome. Yeah. And I would say to the audience, I think Yonah hit a really, really good point here is if you're listening to a good podcast, like Yonah's, he has the reach and the network where he gets all of the educational content through his guests that he could ever possibly need. So, I think it's important. Like I have this tendency there's so many good podcasts out there, and I can listen to 100 podcasts a week, but really if you just focus in on a couple, Yonah being one of those and Weiss Advice, you can learn so much and get all the content you really ever need by listening to just a few podcasts. So Gentle Art of Crushing It, Weiss Advice, you're all set, I think, right? All right. And then kind of a fun one that I like to ask is, what is one bucket list item you have recently checked off your to-do list, or one that you're hoping to in the near future?
Very interesting. I honestly never had like a bucket list of any kind, any sort. So, for me, having 6 kids has always been a challenge with, not a challenge in the fact that, I love them and want to spend as much time as possible with them. But as they get older, teenagers are actually quite challenging. And so, for me, the biggest bucket list that I have is just being able to spend time, and specifically with my daughter, who's now 18, and she's, in her last year of high school, and teaching her about real estate, and teaching her about all the things that I'm doing. And so that's really, for me, like, that's been a bucket list, to be able to pass on to my kids what I'm learning and get them excited about it as well. I
think it's the greatest bucket list item of all. So very, very nice. Thank you for sharing that. So, all right. Well, again, thank you. You've brought so much value, some things that I was not expecting to hear. I really enjoyed the conversation and respect you and the content that you put out there. So thank you so much for being on the show today, Yonah. I really do appreciate it.
My pleasure. Thanks for having me.
Absolutely. And actually, I forgot to ask, but we talked about the podcast, but if our listeners wanted to connect with you, what's the best way to find you?
I'm on all the social media channels. So you should check me out. LinkedIn, I'm definitely most active on. So you can find me there, or you can go to YonahWeiss.com.
Outstanding. All right. And to the listeners, as always, we encourage you to just continue the education process in this passive investing space. Don't sit on the sidelines too long, and take the action, as we heard today, take the action, invest in the first deal. And we're very, very confident that you'll have a positive experience, and it will lead to helping you transition into a new phase of your financial trajectory. So to the audience, thank you so much for being here. Yonah, thanks for being on the podcast. And we will all chat again soon. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.